To Global Money Talk, brought to you by Sampro TV. Greetings to all of our viewers from across the U.S., Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm Remy Blaire, and joining me today for our market briefing and also to weigh in on the top stories of the day is Tai Wong, independent proprietary trader. Tai, good morning, and thank you so much for joining me.
Oh, good morning. Great to be here. Another lovely day, October 15th. And it's a couple of important things today. It's Nietzsche's birthday. Friedrich Nietzsche, the famous German philosopher. He's actually pretty complicated and hard to read. He famously for saying that God is dead, and basically we've killed him because we've advanced in so many ways that we don't need to believe in God anymore. His impact on philosophy is huge. Sort of the moving away from absolutes that the church taught for a long time. But anyway, it's his birthday. Very interesting character. He never really got to finish his philosophy because he got sick and he died quite young. And then also, it's National Mushroom Day. Which is a great source of protein, really interesting structures. I remember a little bit from biology that mushrooms are actually closer to animals than they are to plants.
So what a day it is this morning, and as you mentioned, a lot to celebrate, including mushrooms. So
Yes.
I am hungry since we're fast approaching the noon hour, so perhaps I'll have mushrooms for lunch today.
We'll have them order a mushroom pizza and they'll get here by the time we finish.
Yeah, that sounds really good. Well, you and I were wearing green this morning,
yes.
but the market is seeing red. So
it is.
Dow, Nasdaq, S&P 500, we saw a mixed open this morning, but we are seeing red for the major averages.
Yes.
So given the fact that the Dow and S&P 500 settled at record highs yesterday, what do you make of what we're seeing this morning?
So actually, earnings that came out, the banks, really everybody beat. I guess not a huge surprise. Goldman beat dramatically, but the other banks, Schwab is really a broker. They did very, very well. One of the things that they did superbly was they brought in a lot of new sort of assets, and that's not just the growth in the assets they had under management, but new assets, which is great because that's one of the ways that they make money also two ways I could say. One is if they're actively managing money, they take a fee, but if money is sitting in your account, they actually sweep it in and earn interest on it. And it's one of the biggest ways they make money. So it's really good news out of the financials. But then what's I think dragging on the mood a little bit is what's happening to chip makers, to NVIDIA, and to Broadcom. And the issue appears to be, and I think the reason that they're getting dragged down is in the evening yesterday, stories came out that the Biden administration is thinking about limiting the sale of these high-end chips to perhaps places in the Middle East, which have a lot of money, a lot of demand for data centers, and in an effort to keep them out of the hands of perhaps people that we don't want to have them, China, Russia, whatever it might be, but more limitations on these chip makers, which are working with limitations already. I think NVIDIA sells chips that are modified to go to China because they're less cutting edge or something like that. But it's brought those two names down. I think it's brought the sort of the Mag 7 down, and it's hurt the mood. So after a great day yesterday, I don't know how we're going to finish today. Do we retrace a little bit, or do we climb back a little bit later on? But certainly, it's a little gloomy right now.
Yeah, and as Tai mentioned, we are seeing red across the board, and we are seeing the chip makers down this morning. Earlier when the market opened, we saw the Dow fall by as much as triple digits, and we saw United Healthcare, their shares fell by as much as 10%. They have pared back losses, but this came as they cut their profit guidance for next year.
Yeah, a little bit of a gut punch. They said basically the cost of medications was really hurting them. And they got walloped. I mean, they were down. Last at one point I saw that down over 10%. And back to the financials. Even the financials seem to have given up a lot of their gains for the day, which is a little surprising. I suppose they were expected to beat. They beat, and now the market's like, all right, they did what they were supposed to, or what we expected them to do.
And while we're taking a look at what's moving the market, before we move on to today's top stories, let's take a look at Fed comments, because we heard from Fed Governor Waller yesterday, and it was very interesting to see the reaction to that, especially as we edge closer to the November meeting for the Fed.
So Waller had had a pretty long speech. I actually went and read it. It was pretty long, but to summarize it, he basically said, "I'm pretty happy right now to reduce our rates at a deliberate pace," because he actually said that GDI, which is gross domestic income, is solid, and the consumer, has more reserves, cash reserves, than we think, and they've been waiting for lower rates to actually go and invest and buy homes. So he had a fairly upbeat look on the on the economy, on the consumer, and he said, listen, if things go poorly, we can cut faster. If things go very well, or inflation accelerates and the jobs market doesn't deteriorate, we can pause. So really, the focus remains on unemployment, on the unemployment situation, but he's happy to go slowly. So really, 25 basis points as we move forward in time seems to be the way the market is heading, but again, they are data dependent. I would also add that Waller is a governor, so he votes at every meeting, and he's generally considered a little bit of a senior statesman in terms of, next to Powell and John Williams, that people listen to. He was at the St. Louis Fed, was working with Jim Bullard, who was a long time head of the St. Louis Fed for a while. So the market likes him. They feel that he's reasonable and has strong views, but that are backed by sort of pretty good research. So he's an important guy to watch.
And as you mentioned, we're keeping an eye on economic data this week. We'll get a sneak peek into jobs with weekly jobless claims coming out on Thursday, but also we'll get a better picture on the U.S. consumer with retail sales figures. But of course, as you mentioned, we're awaiting the jobs figure, the jobs report in terms of non-farm payrolls, as well as unemployment coming out on November 1st. But at least we'll get updated figures in terms of jobless claims on Thursday morning.
So actually, I'm glad you reminded me, because another thing that Waller touched upon in his speech was, he said, with the Boeing strike specifically, he mentioned it, and with the 2 hurricanes, he said, the job situation is going to be a mess. I'd expect them to take 100,000 jobs, off the payrolls report. So I think there's starting to be he's certainly discounting the payrolls report, and I think that's going to work its way in to the rest of the market, where they're saying this payrolls report, more than other ones, might be just a little bit messy, and unless there are really some alarm bells in them, certainly we'll watch hours worked, like Danielle DiMartino Booth explained very nicely when she was with us here a couple of weeks ago. I think they're going to just say steady as she goes. Nothing crazy, nothing surprising, because there's too many variables right this moment.
Yeah, and it's interesting that you mentioned that, Tai, because you've described this in the past, that the jobs figures could be a little muddy, given the recent effects of the hurricanes, parts of the Southeast as well as Florida still working their way out of what happened last week and the weeks prior to this. So we'll see that reflected in economic data as we move forward, for sure.
And just an anecdote, my wife works for a big telecommunications company, and they said, after Milton in Florida, they still haven't been able to get in touch with 23 employees. And you're hoping that this is just sort of communications issues, and and nothing more dramatic. Hopefully nothing terrible, but there's still a lot of uncertainty going on. But so muddy, no pun intended, is exactly the right word.
And of course, we'll keep you updated on any weather-related concerns, and of course with jobs figures as well as other economic data coming in. But as you mentioned, Boeing, I do want to take a look at Boeing. So this morning we're seeing shares of Boeing higher by over 1.5%. And we have the chart pulled up here this morning, so it is higher by 1.5%. Boeing announced plans to borrow $10 billion in order to stabilize its finances. And we just talked about layoffs from Boeing the other day. So what do you make of this price action, Tai?
So I think I thought I saw they would maybe shelf as much as 25 billion. So it's a shelf registration, and that means they could tap the markets for as much money as that. Could be bonds, could be stock. Stock is probably more sort of more important. They actually mentioned that they still have revolvers and debt that they could call on, but they're not calling on that right now because there are covenants in there. And so if they borrow and then they issue stock or bonds, then that debt becomes immediately callable by the issuer. So they have some reserves, and the market certainly likes it because Boeing is up on the day. And then there's also that the Labor Department, Julie Su, I think the interim secretary, is working closely trying to get these two guys, these two sides together. And in terms of, after what we've seen with the port strikes, right, 6 years, 62%, they moved relatively quickly. And Boeing isn't, they were, I think the workers wanted 40%, they were willing to give 25, they moved to 30, but there's bad blood, there's something about the pension, so if they can sort of get everybody back together, maybe that bridge isn't too hard to jump over as long as people can put their pride aside and just get everybody working again. The other thing that the government could do to help out Boeing is they have these contracts that are fixed cost contracts, which actually has been tough for Boeing because inflation has gone up so much, but they're still selling sort of planes to the to U.S. military, though they're primarily airlines, but they sell things to the military at a fixed price. So if the government were willing to relax that a little bit, that'll also help sentiment. So Boeing, sort of up on the day when everyone else is down, which is kind of interesting. It suggests there is a Boeing put. We just don't know where it is, but there's going to be a Boeing put. Like I said, I've had a position in it. I'm looking to add a little bit at the right time.
And speaking of the right time, when we think about Boeing, it's been several weeks since the strike began, and the big question is how much longer is this going to last? And there are concerns about a potential downgrade, but what do you think is going to happen, and how do you expect these negotiations to play out for Boeing?
I think the two sides are so sort of angry at each other. I think if you get an interlocutor to come in, whether it's the labor secretary, to come in and say, listen, guys, we're not that far apart. And what doesn't really get reported on is the downstream effects from Boeing not making planes. It's the folks who make parts for Boeing and the people who make parts for the bigger parts makers. There's a cascading effect, probably all over the country in places we don't necessarily see. And if let's say you're a small contractor and you make parts for a big contractor who in turn goes to Boeing, some of those guys might sort of leave and go do other things. Maybe they don't come back, and then you've lost a lot of expertise in a field where you really want the A team building your planes. Boeing moved away from that, and they focused on other things and lost some of the A team, and now look what happened, right? So you don't want to lose the talent. You don't want the downstream effects are actually fairly significant. So I'm glad that the administration might be trying to step in and say, hey, listen, let's get this thing sorted. It's been a month and there's been not a lot of movement.
And Tai, when we're talking about certain industries where the consumer or citizens' health and welfare are at risk, you do definitely want the A-team in place. And when we were covering the port strike while negotiations were taking place between all the sides, we were talking about what this means in terms of the downstream effects and how long it would actually take for each passing day that the ports were closed. So when we're thinking about airlines or even talking about space, for example, this is an area of concern.
And it's when you bring up concern, which is right now the entire airliner business is a duopoly. It's Airbus and Boeing. But there are other players. There's Embraer. I think it's maybe Brazilian. That they make pretty good small to medium-sized jets. Could they go and start making a big one? Do they find a little, sort of a little chink in the armor of this duopoly and start making them? And certainly the Chinese, they can. They're factories of the world. They can really build relatively complicated things. Now, an airliner is fairly different than an EV. There are way more parts, and if something goes south on an airliner, it's going to ruin a lot more days than a problem with an EV. But certainly there are countries who might be saying, wow, if this continues on, is there a little opening? And if you're Boeing, if you're Airbus, you really don't want that opening. You want to keep it a duopoly. So the impact and the concerns you mentioned can broaden a bit.
And Tai, I do want to move on very quickly to look at precious metals, in
Oh,
particular
yes.
gold. So first and foremost, you were on several weeks ago and we were talking about gold and central banks. So down in Miami, the London Bullion Market Association's annual conference took place. And we heard some very interesting comments, but in terms of China's central bank, they held back on buying gold for a fifth straight month in September, but given current levels for gold, what do you make of some of the other countries and their comments?
What was interesting that came out yesterday at a conference was the governor. There were a bunch of central bank, sort of people, investment sort of people there, and so apparently the Mexican central bank, the Mongolian central bank, and the Czech central bank essentially basically said the same thing, or they really agreed with each other and said, well, as a central bank, we like gold. Rates are coming lower, and there's a lot of political uncertainty. They didn't say it, but we've sort of used the dollar as a weapon against people we don't like, particularly Russia. And I think that raised some alarm bells with folks who say, you know what, we have a lot of our money in U.S. dollars. Maybe we shift some of that into gold. And it was interesting that they said it so sort of openly, and they felt that it's likely that we continue to accumulate gold, in the coming year or so. So it seems that certainly gold really didn't react immediately to the comments, but it's higher up again today, and it's only probably less than 1% from all-time highs. It's a bull market. I think it continues to grind higher. I do also think that the S&P is a bull market, and we may see 6,000 at some point, maybe even before the election. Although, famous last words, and we hit the high yesterday, and we're having a bad day today. But it certainly does feel that way. There's so much money coming into the market that unless there's a reason for a sell-off, I think we will still, continue higher until at least we see the results of the election.
And Tai, we've been talking about record highs for the S&P 500. Of course, we'll continue to watch the levels to see where they close today and what happens tomorrow. But while we're on the topic of gold, we've talked about central bank holdings, and given the elevated levels for gold prices, given that the Central Bank of China, that they haven't added to their reserves, at the same time their holdings in terms of value has continued to increase.
Dramatically. I don't think China doesn't, the last time they bought gold was under $2,300 an ounce. I don't sense that I think if we drop back down to those levels, they may buy again. I'm not sure I see them adding at these levels. Certainly, if they start to add again, I would give the gold market a really, really big boost. But maybe they have other things on their mind right now with all the issues that China is going through. I mean, we talked about China a lot yesterday, and but one of the things that one headline that China says, they're going to enforce their taxation of overseas investment gains for their really wealthy individuals, and you say to yourself, is that really the right message that you want to send? Because you really can't tax your way to prosperity, right? You actually want to improve the mood. You want people to bring money back in, perhaps, or give them a tax holiday if they bring money back in. But to say, well, we want to raise taxes. I get it. It's the law, but it's not really. It's the wrong note on the piano. I think at this time. But actually, on the note of commodities, oil is down dramatically today. 4% in both Brent and WTI, and a big part of that is the Israelis have come out and said, or people in the government have come out and said that Israel has agreed not to hit their nuclear facilities or the oil facilities, and basically limit their attacks to probably military facilities. And I think the demand numbers for crude have always been suspect, and we rallied because of concerns that we could have a major conflagration in the Middle East. And as that the risks seem to be receding, you're seeing crude give up those gains very, very quickly. So I think we may stabilize around the high 60s and 70-ish area, but certainly the risk, the risk is not now priced in. Now, if Prime Minister Netanyahu decides, you know what, we have a great opportunity to do some damage here, and they do it, in spite of what they've apparently said to the administration, there's a lot of room for crude to rally back up very, very quickly. And then finally, on that note, Bitcoin having a a really, really good couple of days. Part of that is, I think there are two reasons for it. One is Trump's apparently edging out ahead a little bit in the polls, and he seemed to be more crypto friendly. But also, Vice President Harris saying that she's open to sort of a crypto regulatory framework, and which really I think triggered this last probably $7,000 of rally in Bitcoin, because a lot of the the coins space is saying, you know what, give us some rules, give us some framework so we can work under it, instead of just doing enforcement and going after exchanges for bad behavior. Give us a set of rules. So, does this get Bitcoin back above 70,000? I'm not quite sure about that, but certainly the mood has been very good the last couple of days. Maybe the move up a little too violent to be sustained, and we need to retrace a little bit. But Bitcoin, folks are happy this morning.
Yeah, we've been seeing quite an advance in crypto majors today. We are pulling back after a higher open, but Bitcoin is still elevated above the 65,000 level. So before we wrap it up for today, I think we should shift on over to the Eurozone.
Oh, yes.
Because we got a handful of economic data releases, and we have the European Central Bank meeting later this week. You and I were talking ahead of the show about rate cuts. So what do you expect to see from the European Central Bank this week?
So they had, there's some interesting data out. So industrial production in the Eurozone about on consensus. But the thing that really jumped was the ZEW Economic Sentiment Index out of Germany. 20.1 versus 16.9, certainly an improvement over what it was before, and industrial production year on year was actually also a little bit better. So the ECB, in a dramatic turnaround, is expected to cut 25 basis points on Thursday. There have been some whispers that because the major economies in Europe are actually, had really poor data over the last few weeks, that maybe it's time for a surprise 50 basis point cut. That would really, I think, stir the markets. I don't think the market has that priced in, but worth talking about. There's just a couple of whispers. I don't think they'll do it, but that might be something that kind of jumpstarts the Eurozone, which they could probably do, because the problem with Europe is their markets and their employment contracts and their entire economic structure is a lot less flexible than the U.S. You can't hire and fire the way that the U.S. typically can, and that has made Europe a lot less flexible, and their growth has been a lot slower over in recent years because of that.
And when we think about the Eurozone, there are different countries there, and each one has their unique situations when it comes to growth as well as inflation.
That's right.
But when we're talking about whisper numbers, do they have their own whisper similar to the Fed stateside?
Yeah. There are people who will come out and say, it's time. Maybe they ought to cut 50 basis points, and that whisper number is, it's probably true in most markets. You get it more here because I think we're in the U.S. We cover the U.S. a little bit more, but certainly in Europe, and there are 20 odd countries, in the Eurozone. So, and as you mentioned, there's a lot of, France is having a lot of political issues and economic issues. Germany is potentially falling back into deflation. Italy is doing all right, but not usually too far away from worries. And it was probably 10 years ago now that we're talking about breaking up the Eurozone because Greece might have to leave. So there's a lot. There's it's a contentious place. It's sort of the north of Europe, which are generally the Germans and the German adjacents who really want a strong monetary policy because they're definitely afraid of inflation. because of what happened probably a century ago, but they're afraid of it. And then there's this quote unquote the south of Europe, which will always want easier policy because their economies are not really as well constructed as the north.
So Thursday morning will be busy with the ECB weekly jobless claims as well as retail sales and other topics to cover. So I look forward to covering all of that, of course, on Thursday. And thank you so much for joining me. We'll be back tomorrow. Thank you so much, Tai. And coming up, I will be joined by Tobin Marcus, Head of Research, Head of Policy and Politics at Wolf Research. Don't go away. We'll be right back. Welcome back to Global Money Talk, live from the New York Stock Exchange. Election Day in the United States is on November 5th and is only 20 days away. As we kicked off the week, Vice President Kamala Harris and former President Donald Trump held events in Pennsylvania. The vice presidential nominees were also campaigning. Governor Tim Walz in Wisconsin and Senator J.D. Vance in Minnesota, Illinois, as well as Iowa. Now Harris and Trump have both announced new policy ideas, with Harris proposing credits for newborns and home buyers, while Trump suggested tax cuts on overtime pay, Social Security benefits, and breaks for auto loan interest and state and local taxes. Well, joining me today at the New York Stock Exchange for our Market Insight is Tobin Marcus, Head of U.S. Policy and Politics at Wolf Research. Tobin, thank you so much for joining me.
Happy to be here.
Well, the countdown to Election Day is on here in the U.S., and it's hard to believe, given everything that's happened so far in 2024, that it's around the corner. But first and foremost, I do want to get your perspective. So, given the possible outcomes, starting out with the presidential race, what do you expect?
Yeah, so look, I think we're headed for a close presidential election. I think that much is clear. That's always been our expectation. Even going back to the beginning of the year, we figured it'd be tight just based on how presidential elections have gone, for years and years now. The last two presidentials have been decided by very, very small groups of voters in a relatively small set of swing states. And I think the partisan fundamentals of the country are very closely divided. So, there have been some ups and downs in the polling. Again, it's been an incredibly tumultuous 3, 4, 5 months going back to Biden's disastrous first debate performance, eventually dropping out, the assassination attempts on Trump, the second debate. So the polling has swung a little bit, but it's still been, I think, surprisingly range-bound given how much news there is. I think that Harris probably has a slight edge. That's what the polling has pretty consistently indicated since August. Very, very narrow leads in enough states to get to 270 electoral votes, which is the key target. Betting markets in the past 2 weeks or so have been swinging back a little bit in Trump's favor. I think that narrative, the sort of talk about a vibe shift in the election, is a little bit outpaced any actual developments on the ground. So I'm not yet convinced that there's been some big durable shift back in Trump's favor, but from an investor perspective, you can debate whether it's 55-45 one direction or the other, but over the course of the next 3 weeks, I think it is certainly going to be the case that we're going to have too little confidence about the outcome for most big institutional players to be wanting to make big directional bets one way or another. The folks that we're talking to in terms of our clients are very much still in scenario planning mode, trying to understand, what do the outcomes look like in these different worlds, rather than, making a confident prediction about who's going to win and slamming trades as a result.
And Tobin, you've highlighted how eventful and tumultuous this year has been for the presidential candidates, and only months ago Biden was still in the race. So when we think about Harris's campaign cycle, it is a very short one, and one that has been highlighted, especially as the debate, the first and only debate, took off between them. And of course, when it came to the vice presidential debate, all eyes and ears were on that debate, more so than previous vice presidential debates, just given the nature of this election cycle. But you brought up your conversations that you're having with investors as well as clients. So what have been some common themes that you have noticed?
Yeah, so there have definitely been some cycles to the way that that big institutional buy-side players have engaged with this election. I think through the first half of the year, there was some kind of ambient planning, wanting to understand the basic contours of the election, the kind of high points of the policy agendas on both sides. And then we really saw, after the first debate, when it looked like Trump might just be cruising to an easy victory before Biden dropped out, after Biden's numbers collapsed, so before he dropped out, I think that's when we really started to see folks tuning in, deciding that they needed to get their head around, all right, if Trump really is just on a glide path to victory, such that we're going to be able to plan around that for most of the year, then we need to figure out the content of that agenda. And then we've seen things shifting back a little bit more in the other direction recently. So, there have been, I think, certainly some persistent big questions about the policy landscape under these candidates. On the Trump side, I think we've spent a lot of time talking about tariffs, which obviously have been a center point of his economic agenda, something that he has tremendous discretion to do what he wants to do without a lot of need to go through Congress, and where he's proposed an incredibly aggressive agenda. So we've had a lot of conversations about what could really happen there. To some extent, a similar story on immigration, where if he really succeeded in deporting 15 or 20 million people, it would have incredibly disruptive consequences, but probably we're not going to end up with something at that scale. And then tax policy, I think no matter who wins next year, we're looking at a huge tax cliff in the U.S. as the individual tax cuts from the 2017 Trump tax package are set to expire at the end of next year. And so that creates a lot of variability in what could happen in terms of tax policy next year. Very different outcomes, of course, depending on whether we get Trump with a Republican sweep, Trump with divided government, Harris with divided government. I think somewhat less likely, Harris with a Democratic sweep. But that's where, for example, some of the risks around clean energy, I think, are primarily in that space, where it's possible, in the context of a big party line Republican fiscal bill next year, that's where we could see some changes to the Inflation Reduction Act, for example.
And Tobin, we're here at the New York Stock Exchange. We continue to see record highs for the major U.S. equity averages, but it has been quite the volatile year given everything that's happened. And of course, when it comes to the macro landscape as well as policy landscape in terms of monetary policy. There are so many expectations as we headed into this year, but here we are heading into the final months of the year as well as the final quarter. So I do want to dive into the other parts of politics in terms of the election. So the race for Congress, what's going on there right now?
Yeah, absolutely. So down ballot from the presidential, I think the clearest picture is at the Senate level, where the Senate map this year very strongly favors Republicans. They've effectively already flipped one seat with the retirement of Joe Manchin, who's now an independent who caucuses with Democrats. That's a deep red state that Manchin was the only Democrat or Democratic leaning senator who had any chance of winning. So that's effectively as good as gone. Beyond that, Republicans just need to pick off one more seat, with Montana being the obvious race. John Tester, Democratic incumbent, has been trying to defend that seat, but Trump is going to win Montana by 15 to 20 points. I think that is too big of a deficit for even a strong Democratic incumbent in Tester to survive. So that alone would be enough to deny Democrats a Senate majority, even if Harris wins. If Trump wins, the job is already done. They don't even need to flip Montana because they'd get to 50 already in West Virginia. So the Senate's very lopsided. The House, I think, is much more evenly split. Our expectation has always been that the House will go the same way as the presidency. They're obviously correlated outcomes. They tend to go the same way. But there has been a debate in D.C. I think there's been a little bit of, frankly, a little bit of a lazy conventional wisdom that, we're going to have divided government one way or another. Even if Trump wins, he'll probably have a Democratic House, just like Harris will have a Republican Senate. But we've never thought that there's good evidence for that view. I think if you, we've seen some analysts kind of saying, well, Trump's 50-50 to win, and then if Trump wins, he's 50-50 to have Democratic House across from him. But that implies something in the neighborhood of a 75% chance that Democrats win the House, and I don't think that there's any evidence that Democrats have that magnitude of edge. So, to us, that adds up to a pretty bimodal distribution of outcomes, where there's a very small chance of a blue sweep on the far left, and then a high chance of a divided government under Harris with a Republican Senate, and then again a very small chance of Trump plus a Democratic House, and a large chance of Trump with the Republican sweep. So, we think that the two big scenarios investors should be planning around are, on the one hand, divided government under Harris, and on the other hand, Republican trifecta under Trump.
And Tobin, now that we've set the table for today's discussion, I do want to take a look at betting markets. So for our viewing audience who may not be familiar, can you explain the intricacies of this and how this actually works?
Yeah, so there are a few different sources of market odds that people tend to look at as points of comparison to the polling, sources of expectations about the elections. The two big kind of market-based indicators are Predictit and Polymarket, the latter being a longer-standing venue that's operated under a sort of non-enforcement from U.S. securities regulators with relatively small position limits, but kind of multi-cycle track record. Polymarket is a newer venue, theoretically open only to non-U.S. Participants, with most of the activity conducted in crypto. So Polymarket's leaned a little bit more to the right. There's some questions about which one is a better measure. We tend to look at both of them. And then there's now a newer entrant in Kalshi, which is sort of just now in the process of litigation against the CFTC about whether or not they'll be able to get involved in a more sort of full-fledged way as like a genuine sort of options trading venue in the U.S. under sort of complete sign-off from the authorities. That's new enough and has small enough volumes this cycle that we're not looking very closely at it, but those are the main sort of sources of betting market odds, along with the actual kind of odds makers in terms of traditional bookies and so forth. Some of them publish odds also, so we try to look at all of them.
And when it comes to the presidential race, what are these markets telling you right now?
Yeah, so I mean, at the moment, they have shifted pretty significantly back in Trump's favor over the course of the past 2 weeks. I think for the most part, they've tracked relatively closely with the odds that are generated by the kind of polling-based probabilistic forecasts. We tend to follow those models most closely. I think they're the thing that has the best track record. The betting markets, I think, are a really good way of getting a real-time pulse on what's going on. The great indicator of consensus, a good way, when you're in the middle of a period of volatility, like during the Harris-Trump debate, for example, they swung in real time. I think that was a good indicator, a good gut check that many other observers are seeing the same thing that we were seeing, which was Harris kind of handily winning that debate. But we've seen some irrational exuberance in those markets in the past. In late 2022, for example, there was a lot of narrative about a so-called red wave in those midterm elections that was never really borne out by the polling. So, the polling shifted a little bit to the right in the late, the kind of final weeks of that campaign. With a lot of Republican-sponsored pollsters in particular, kind of putting out a lot of polls. In their view, things were shifting, like breaking late for Republicans. The betting market swung, I think, much farther than the polling in that direction and turned out to fall short. So I think not, there's some, we get questions sometimes that are like, aren't the markets just the best indicator of what's going to happen here if they're taking in all the available information? This is people who have real money at stake as opposed to pollsters just taking their best guess. And it hasn't really panned out that way. So, at the moment, in the presence of a little bit of a disagreement between the polling-based models and the betting markets, we're, I think, a little more in line with the polling. But, at a minimum, it's an indication that, that there are, the consensus is shifting. And I think there's more openness to the possibility that Trump may have a real durable edge here as opposed to the coin flip election that a lot of people have been seeing for the past couple of months.
Well, Tobin, I do want to move on and ask you about polls. We all know that hindsight is 20/20, but before we move on to polls, because you mentioned the word crypto, and that is a market that we can watch 24/7 versus the bond market or stock market, and given a lot of the events that happened this summer regarding the presidential race, candidates as well as assassination attempts, it was very interesting to hear the crypto community react. And I'm not just talking about price action in terms of Bitcoin or the crypto majors, but what do you think about crypto as a campaign issue and just how this community has gotten so involved?
Yeah, no, it's been a really interesting cycle. I think certainly we've seen the emergence of both institutional crypto players as a lobbying force, a campaign donor force, and to some extent like grassroots individual crypto owners as an important political constituency. It's definitely, I think, still niche in terms of the number of voters for whom that is the decisive issue, which is a much smaller group, obviously, than the set of people who own or have ever owned crypto that you see in some of these surveys. But this is very much going to be a campaign that's decided on the margins. So even relatively small groups I think have a chance to be influential. We're seeing that again this week with Harris rolling out this sort of targeted kind of black opportunity agenda that includes essentially a kind of promise to protect crypto assets, making an attempt to say, if you are, sort of younger black man, for example, where survey data shows crypto ownership is relatively high, if the reason why you're thinking about voting for Trump is because you think he's going to protect your crypto investments and Harris won't, she's going to try and reassure you, take that issue off the table. So, I do think that from a policy perspective, the crypto regulatory environment is moving in a friendlier direction one way or another. Trump's been very overt about that. But even if Harris wins, I think we've seen, to some extent, the SEC reach the limits of what courts are going to let it do in terms of its aggressive sort of, regulation by enforcement approach that it's been taking. We've seen some signs of growing interest in actually getting something done in terms of digital asset regulation in Congress. There's this bill called Fit 21 that got through the House on a very strong bipartisan vote, including some surprising support from sort of senior Democratic leadership in the House, including Speaker Jeffries a couple months ago. So I think that the legislative period at the end of this year might be too soon to get that done because it's going to be a very, very contentious period given that we'll be coming off of this closely fought election. We may still be in the middle of election litigation by the time it comes time, like the legislative window kind of opens. But if we play the thread out a couple years, I think no matter who wins in November, I do think there's going to be bipartisan interest in getting some kind of structure in place for crypto that's both more predictable and a little bit less hostile than it's been for the past couple years.
Yeah, it'll definitely be interesting to watch what happens, not just in the coming weeks or months, but heading into the new year when it comes to crypto legislation. But since you mentioned surveys, I think it's a good time to talk about polls and polling when it comes to the presidential election. So the polls are showing a toss-up in the presidential race with key battleground states still close. So what do you make of what we're seeing in polls, and can you give us an understanding of how they work and what to pay attention to?
Yeah, so the polling industry, polling is a tough business. I'll say as someone who spent some time working in polling, I would not advise any of our audience to invest in. If you have a chance to invest in a pollster, I'd tell you not to. There's I think the industry has struggled for years with the problem of falling response rates. I think there's been a lot of interesting adaptation to that. Polling today is more multimodal. There's more efforts to draw respondents from multiple different channels, whether it's live callers, calling cell phones, sampling from online convenience panels, SMS-based interviewing, where you're recruiting people to take surveys online based on text to their phone. Some people will do mail recruitment of sort of consistent panels that they go back to and survey over and over again. So I think we do see diversity of methods. I think that does help for correct with some of the shortcomings of any individual polling methodology, but it is definitely a challenge. That being said, I don't think that polling is kind of broken or ought to be ignored. Obviously, there were big polling misses underestimating Trump's support in 2016 and 2020, but we had quite accurate polling in 2018 and 22. So, we're cognizant of the possibility that this could be a Trump-specific effect. Maybe there are voters who are Trump supporters, but not consistent Republican supporters, or people who don't turn out in midterms, that those are the people that are sort of most challenging to capture. So we could easily see another polling error in Trump's favor, but I think the starting point ought to be that polling, is capturing important information, that it works. I think it's better as a sort of prior than anything else that you can go on. Again, looking back 2 years, we saw a lot of people in 2022 go very wrong with an assumption that either polling is totally broken, and so we should be crafting our expectations for this election just based on the context, which, with inflation then running totally out of control, would have pointed to a kind of huge washout win for Republicans. Or on the other hand, that you just ought to tack on 3 or 4 points of Republican support to any poll because it's consistently underestimating Republicans. Again, that pointed people towards expecting a red wave that never really materialized. So, we tend to look at the averages more than individual polls. There certainly are some polls that are higher quality than others, but I think generally the models have acquitted themselves pretty well. Even looking back at some of these cycles that have had big misses, like in 2016, the betting markets then had put even higher odds on a Clinton win than, for example, Nate Silver's model did at the time. So I think even in these periods where the polling has missed, polling-based models that do a good job of accounting for uncertainty in the way that they do the probabilistic forecasting, I think have been a better guide towards the likelihood of different outcomes than the betting markets of those times have. In terms of what we're seeing in the polling, it's been very close. All 7 of the swing states are well within a very typical polling error, but thus far, pretty consistently going back to August, Harris has maintained narrow leads, sort of in the 0.5 to 2 point range in enough states to get to 270. So could go either way. It would not be at all surprising to see a polling error in either direction, but it's better to be ahead than behind. So that's what we tend to give an edge to Harris as a very slight favorite based on that polling, despite the level of uncertainty that we're looking at here.
And we have about 3 weeks to go, so I'm sure whether or not it's advisable for the health of your blood pressure or not, I'm sure we'll continue to keep an eye on those polls. And I do want to take a look at policy because I think it's very important, obviously, when we're talking about the candidates and the implications here. So let's just say that we get a Trump win. What are the most significant policy shifts that you expect that investors need to account for here?
Absolutely, and from an investor perspective, certainly policy is what it really comes down to. These elections only matter for markets insofar as they're actually changing the kind of policy inputs that are going to shape outcomes in these sectors. So, look, I think in terms of things that we're looking at as relevant to markets in Trump's first year, if he wins, I think first and foremost, tariffs are probably the biggest question. Again, this is a place where he has tremendous latitude to do what he wants to do. I think it's something that he is very serious about. That's been a debate. Certainly we've heard some other consultants, mostly on the kind of business-friendly Republican side of things, telling people, ultimately his bark is worse than his bite. He wants markets to go up. He's going to say crazy stuff but do something that makes sense. We read him as being pretty sincerely committed to his tariff agenda and a pretty genuine believer in the power of tariffs as an economic tool. So I think that's a risk that investors need to take seriously. He's talked about 60% tariffs on all Chinese imports, as well as 10% or higher tariffs on all U.S. imports from anywhere around the world. And I think the latter of those, the 10% global tariff, that to us looks more like negotiating posture that's going to lead to be the sort of threat that is the premise for a set of conversations with our major trading partners to try and get concessions, whether it's trade concessions, currency, FDI, any number of things. But the China piece of that we do take quite seriously. So that is one of the biggest sectoral risks. and probably the biggest shaper of the differences in the macro outlook between Trump and Harris, because that is something that I think has important impacts on inflation, to some extent on growth, and certainly on Fed policy as we get deeper into 25 into 2026. The second big category, I think, is regulatory shifts. Trump's been quite transparent that he wants to move in a broadly deregulatory direction. Biden's had a pretty aggressive regulatory agenda across sectors. Substantially all of that stands to be rolled off under Trump. I think the big winners there are probably financials, to some extent traditional energy, although I'd be less confident that the benefit for energy is durable. I think that's a place where probably get positive sentiment immediately after a Trump win. But the actual cost of the energy regulations that Biden's put in place are pretty backloaded, so it's not as clear to me that you see sort of persistent benefit for energy throughout an entire second term, which for what it's worth would be in line with his first term when we saw energy kind of pop shortly after the win and then underperform in the 2017 to 21 period. The third category I think would be immigration. Certainly we're going to see Trump clamping down on flows in the border, for example, by ending the humanitarian parole programs that Biden's put in place that are effectively letting in about 75,000 people a month on a kind of a quasi-legal basis. The question there is, from an internal enforcement perspective, is he really going to be able to deport 1 million, 5 million, 15, 20 million people as he's indicating that he wants to? We think that that's going to prove pretty operationally challenging, so we don't necessarily expect that big an increase in the pace of deportations, but if he does sort of manages to do more there than we're expecting, that's something where you do have to worry about both the supply and the demand side of the labor market. With I think retrospectively the levels of immigration that we've seen over the course of the past couple of years have been an important ingredient in being able to run payrolls fairly hot without, like, at the same time that we're bringing inflation down. Looking forward, as payrolls have cooled, a little bit less concerned about the inflationary risks, but again, if you start pulling millions of people out of the labor market, then we start to get more concerned again. And then finally, tax policy, as I mentioned before. We have a huge tax cliff at the end of next year. It's going to need to get addressed somehow, no matter who wins. If Trump wins, I think he's probably coming with Republican House and Senate, and so they will use reconciliation, which is a sort of special legislative procedure that you can use to get fiscal bills to the Senate with 50 votes rather than 60. So that means if every Republican can hold together, and there will be a very strong incentive to do so, they can push through essentially whatever they want to. But the deficit is going to be a concern. We're starting with a $4 trillion plus price tag just to prevent taxes from going up. That's in the context of a debt to GDP ratio that's 100% and rising. So I do think that there will be some sticker shock around that bill. Trump's proposing $10 trillion plus in tax cuts at this point. Certainly they're not going to be able to do all of that. So I think that there will definitely be some triaging there and some tough conversations about the extent to which they need to throw in fiscal offsets to bring the price tag down. That's the context in which we worry about partial IRA rollback, where I do think that there will be a lot of interest across many parts of the Republican Party, not in root and branch repeal, not in like an immediate cliff of all these clean energy tax credits in 2026, but in scaling them back over time as part of an effort to make the numbers add up on that package.
And Tobin, you've covered so many issues, and I wish we had time to dive into each and every one that you mentioned. But I do have to ask you about the same for Harris. But before we do that, just given that there's been so much confusion over tariffs and how they actually work, can you just give us a brief overview of how tariffs are implemented and who ends up bearing the burden of these tariffs?
Yeah, so the president has a wide variety of different authorities to impose tariffs in the U.S. The China tariffs that Trump imposed in the 2018 and 19 trade war were done through a provision called Section 301. Our expectation is that he would use that same tool to do China tariffs this time around. The bigger question is around these global tariffs, which are more novel. There's been conversation about Trump using a law called IEEPA, which is a sort of general purpose international emergency economic authority, along with a few kind of little used provisions of the overall tariff toolbox that presidents have. One way or another, I think they will probably be able to cobble together the legal authorities to do what they want to do. So it's more a question of will and judgment than it is a question of legal authority. In terms of who bears the brunt, the economics is clear that largely the cost ends up being internalized by U.S. consumers rather than being internalized by Chinese producers or other foreign producers. Currency adjustments can absorb some of that. When we look back at studies of the China trade war in Trump's first term, you certainly do see some level of the tariff shock being absorbed by Chinese producers, but the majority of it flowed back into U.S. consumers. And so that's why, when you look at these kind of surveys of economists, like the Wall Street Journal had another one this week, they overwhelmingly agree that Trump's agenda looks pretty inflationary and more so than Harris's. So I mean, we get a lot of questions about this from China, like doesn't the fact that this is an obviously inflationary policy in the context of a still somewhat unlanded, inflation picture, shouldn't that stop him from doing it? And again, we just point back to how he's talking about it, what he says. He does seem to be quite sincerely committed to this, despite the fact that a lot of economists have made this point. He does not seem convinced.
And of course, I do want to ask you about a potential Harris win. So the same question that I asked you for Trump, what would this mean if we did get Harris in the White House?
Yeah, so I mean, a Harris win looks a lot more status quo, both because she's coming off 4 years of Democratic governance already, which means that a lot of, from a regulatory perspective, for example, a lot of the ideas that are floating around to the Democratic side have either been implemented or tried and failed, since Biden has attempted a lot of regulatory moves that ended up getting struck down by courts. We have a pretty big disparity right now between conservative-leaning courts and what has been a very aggressive crop of progressive regulators under Biden. So things like student loans, things like caps on credit card late fees from the Consumer Financial Protection Bureau, a lot of that stuff has run into serious problems in the courts. I think we're mostly looking at the status quo from a regulatory and executive action perspective, with not a lot of new ideas that have any chance of surviving litigation. And then from a legislative perspective, I think she's pretty much going to be forced into bipartisan fiscal deals as the main outcomes of next year. If she doesn't have the Senate, as we expect that she won't, the stuff that she's proposing kind of week in and week out, whether it's these new, the big expansion of the child tax credit that you mentioned, subsidies for housing, her so-called care economy proposals in terms of child care, or the proposal to cover long-term care in Medicare that she rolled out last week, none of that, I think, is realistically going to be doable in a bipartisan Congress. So, in the first half of the year, they'll need to raise the debt ceiling again. I'm optimistic that will be a less tumultuous process than the 2023 debt ceiling showdown was, but probably will result in some extension of discretionary spending caps, again, as we saw in 2023. And then after that, they'll move on to this tax debate. And I think we're looking at extending most of the expiring provisions, as first Biden and then Harris has proposed to do, but allowing some of them to expire on higher-end households, sort of broadly the top 5% of households, those making more than $400,000 a year, is the threshold over which Democrats want to let these tax cuts expire. And I think we'll end up with something that pretty closely resembles that. And that's what happened in 2012 when we finally dealt with the expiration of the 2001 and 2003 Bush tax cuts, is we ended up extending most of them, making most of them permanent, allowing them to expire at the high end as part of a bipartisan deal. If that happens, I think that's a pretty benign set of outcomes for markets. Relatively little shift on the regulatory side, relatively limited tax increases, which has some level of contractionary fiscal shock, but with very low multipliers. The place sectorally where I think there's an underappreciated impact is on REITs and MLPs, master limited partnerships. These pass-through entities do get a special 20% tax deduction. That is one of the things that stands to expire. And so if that's allowed to expire at the high end, as I think it would in divided government under Harris, you'd be looking at effectively roughly a 10 percentage point increase in the top marginal rate on income from REITs and MLPs when that income actually is realized by individuals and they have to pay individual taxes on it. To my mind, that ought to pretty significantly reduce aggregate market appetite to hold those assets and cause some rotation out of them, and that's something we've found has flown very far under the radar. But it is those kinds of niche impacts that we'd be looking at in a Harris win scenario, because there's just not room for the kinds of huge shifts that are possible on areas like tariffs if Trump wins.
And finally, before I let you go, I do want to ask you about sectors in terms of the biggest winners if Trump wins and if Harris wins.
Yeah, so if Trump wins, I think financials are probably the single clearest winner, along with crypto. To the extent that we're thinking about crypto as a distinct sector, I think certainly that would be a winner. Financials, I think, are a place where financials and energy are the sectors that have traditionally overperformed in election years when Republican presidents end up winning. And then you also have, I think, some pretty material regulatory levers that would move in a more friendly direction under Trump, with the Basel III endgame rules being first and foremost among them. Huge issue for large cap banks over the past couple of years. Alongside fins, I think traditional energy to some extent, parts of managed care, those are probably the sort of biggest winners under Trump. And And then under Harris, I think it's mostly about the sectors that win from taking off risks if Trump wins. So clean energy is probably the clearest one if you can get that IRA repeal risk off the table. To some extent, China-exposed names in the industrial and consumer sector, I think are winners. But the tariff risks have been a little bit less priced into markets over the course of the year. So I wouldn't necessarily bet on kind of big pops for some of those China-exposed names, but I do think they see downside under Trump. It's not there under Harris. And then in the healthcare space, again, I think the managed care picture is kind of bifurcated. Under Trump, the names that are most exposed to Medicare Advantage tend to win. Under Harris, the likelihood that you get extended, these expanded tax credits in the Affordable Care Act exchanges would be probably extended under Harris, probably expire under Trump. And so for the managed care names that are more levered to Medicaid and the exchanges, I think those probably stand out as winners under Harris as well.
Okay, Tobin, well, we have to wrap it up for today, but thank you so much for giving us such a great overview as we edge closer to that election day here in the U.S.
My pleasure. Thanks for having me.
Thank you. And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on Sempro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thank you so much for joining us and have a great day.